de la famille.
Hey everyone, hey Balthazar. So this week for the
Mathias.
family in good company, you get to spend an hour with Balthazar and I. And we're going to be spending quite a bit of time talking about our new model at the family and how we fit in the new landscape. And all this was inspired by a tweet by a friend of ours at Angular Ventures, and we'll get back to talking about that. But essentially, the agenda for the evening is, the European evening is talking about the new fundraising landscape for early stage venture, what execution means for early stage founders, and whether or not that's something that can be taught alongside ambition, the value that we find in community and the batch model, as well as how all this changes or doesn't change things for founders building startups in what we call remote geographies. So in ecosystems that aren't necessarily the most dense in terms of funding or startup activity. The idea is really to tell you more about our work at the family. And so really feel free to ask as many questions as you like. We'll be talking about a lot of these things ourselves, but if anything comes to mind, if anything isn't clear, if there's stuff that's relevant to your startup, feel free to ask it. It's quite likely that it'll be relevant to other people as well. So in order to get the conversation started, I thought I was going to give a bit of context on why we decided to pick this topic. And the reason we decided to do that was there was this tweet, and it's a more general conversation that's been going on for a while now, about how very early stage funding has changed. And so Gil Dibner at Angular was saying, somewhat provocatively, but probably kind of true, that it had become almost impossible for accelerators and incubators to work alongside pre-seed funds, just because, or seed funds even, just because of the way fundraising dynamics have changed. So maybe Balthazar, you can get a bit of context on that, and then we'll bounce off each other from there.
Yeah, hey everyone. Really pleased to be here with you. We've indeed had a lot of discussions internally on the value we provide as an accelerator, on the value seed funds or later stage funds provide, and on the value of community, and how being surrounded by some of the best founders actually helps you become a better founder yourself, and where that dynamic can help you increase your execution level. And the context is that some funds are getting more money, and some of them are understanding, on one end, they're understanding the market better, which means they're able to invest earlier in companies because they feel that it's less risky than it was a couple of years ago. That's like very true in SaaS, for example. And on the other side, these investors get pushed to the earlier stages by larger funds that can invest afterwards. And so the result is we see a lot of pre-seed deals being done for founders that haven't started yet. They probably have like a pitch deck, maybe they have an early MVP, but they definitely don't have a product and traction. And so those companies tend not to go to accelerators anymore because they get like 500K tickets from angels and funds. We see that in Europe a little bit. We see that in the US a lot. I've recently seen someone saying that they were issuing like investment tickets for employees at large companies in case they dropped out. So if you quit your job and you get to start a business, you already have 500K lined up, which is basically as early as it can get.
And so when you were saying that it was especially relevant for different types of verticals, so in particular SaaS, where people sort of understood a lot of the dynamics, both in terms of go-to-market strategy and where the actual risk lies. I think it's also true, at least in Europe, that that kind of deal really works for a specific kind of founder. You see a bit less of the sort of younger founder, even if they are building SaaS products. I don't think we see that much happening yet.
So definitely what I think is it's a great time to be a founder. Whether you're first-time founder, second-time founder, ex-employee at a great company, there has not been any better time to start a business. You have tons of ideas out there that are worth pursuing. There is more money than there ever was to fund you. The risk appetite from investors is at crazy levels. And so I think all of you should consider starting a business if you're passionate enough about something you want to build. Then, if you worked at Algolia, if you know the French companies, or at Revolut, or at Stripe, you're very likely to be able to fundraise straight out of the gate. Yet, if you're a first-time founder, you're out of university, maybe you're still at university, and you go and talk to these VCs or angels, the likelihood that you get money straight out of the gate is very low. The investors are going to prefer investing in a founder that has already proved that he's good at execution rather than in you. You might be smarter, you might have a better idea, but there's a big risk that you don't know how to hire, you don't know how to fundraise, you don't know how to ship product effectively. So these first-time founders tend to be forgotten from this like pre-seed stage that we see in Europe and in the US. And I think that's one of the big value that we provide at the family. If we look at our track record, most of the founders that we've worked with second-time founders and first-time founders, but every time we met them, it was at the earliest of stages. They were just founders, had an idea, had done the first few important decisions in their entrepreneur journey, whether it was to quit their job or how they were going to build the first product. And based on those little decisions, we're able to select them. And then I think in the last batch that we had this January, I think like seeing peer pressure and seeing others do stuff really improved the way all the founders work with make decisions. And so I personally feel very excited about all these first-time founders. I think Facebook, Airbnb, Dropbox, we're all first-time founders, and I think like majority or like if not significant part of the outlier outcomes are going to come from founders that haven't proved anything before.
Yeah, and I think that's pretty true. Even if you just look at our batch, the companies that are more left field, and where it's true that you might have more of certain kinds of risk, but also a lot of potential upside, tend to be started by very first-time founders or people who, for whom it's the first experience of any kind, starting a business.
The saying they didn't know it was impossible, so they did it. I think is very true for founders. Every time I talk to someone, they were saying like, if I knew what I was gonna get started, I wouldn't have started. Even the Stripe founders, they thought that payments was easy when they decided to build a payments company in 2008, and like Patrick Collison is still saying that he doesn't understand payments fully, which is crazy.
So before we get to the execution stuff that we said we'd discuss a bit, I thought it was interesting the point you made about this sort of chasm that was existing between smaller funds, where funds are being pushed down to invest and take on more risk and invest before there's a product, and then funds that are getting bigger. And I think that's definitely true. I mean, this is probably one of the trends on which Europe has caught on fairly quickly, is that we're seeing these bigger and bigger funds here in Europe, funds that were bigger getting bigger. They're providing more different kinds of services. And we're also seeing sort of like loads of small funds or even just solo GP funds that are kind of popping up everywhere. And I think that it's quite funny. Like, it's still quite hard for me and pretty blurry where the limit actually lies, because you do get some of these solo GP funds that are doing what would have looked like Series A deals before. And you're also getting some of these very big late stage funds that are doing deals that they would never have looked at. I mean, like, SaaS deals that are making 5K in MRR, that are raising from some of the biggest funds out there that used to say they only did Series A and B. And I think that it's getting increasingly complicated for founders to really understand where they fit on that map, because everybody seems to be saying that they do kind of everything and they support founders from the earliest days.
Yeah. So I think the most important part for founders is to understand that they're building a business for themselves and not for investors. And when I mean for themselves, it's them as founders and of course their clients. And in Europe, at least at the early stage, I think that there is still a big lack of money. I think every early stage fund is going to say the opposite, and it's becoming super crowded, and there is too much money and too much competition. But in my opinion, they're all chasing the same type of deals, which are like second-time founders or founders that already operated somewhere, building the same type of businesses, whether it's SaaS or fintech. And there is a big lack in diversity in the type of founders being funded, but also the type of companies. And every time we do work with a company that has, I don't know, heavy operation model or like a market that is poorly understood by investors, it becomes really difficult to fundraise. Although Apple is doing hardware, Amazon is doing logistics at scale, and most of the great businesses are doing something that nobody really understands. So I I think that there is still a lack of funding at that stage, especially in geographies outside the main hubs. And I would consider Paris, London, Berlin being somewhat in the main hubs. And for those companies, getting access to money has become much easier since COVID started, because investors started doing Zoom deals. Yet it's not so easy. You still need to speak the same language. By language, I don't mean French or English. I mean like you need to have the same culture. They need to really understand that you are similar to them. And that's why one of the advice we give to all founders is just to follow every investor on Twitter, to just get a feeling of how they think, what they talk about. Becoming friends with someone is at least half the process, and it's much easier to become friend with someone that you understand very well. It reminds me of a story of like a, secret detective, where the guy taught me in class that it was super easy for them to become friends with people because they had so much intel on the persona. Like they knew that the guy loved, I don't know, Paris Saint-Germain football team, that he went to the movies every Friday, and whenever they started to engage, they would like do it this way. Like they would like spit a coffee on someone, say they're very sorry, then they would offer a ticket for a Paris Saint-Germain game to the guy, saying that there was compensation for the shirts being uh, not being clean anymore, and so the person would accept. Then they would go to the game together. They would build the initial relationship, and then from that they would build the trust. And of course, it was at the end, it's not for the good cause. But I think with investors, it's actually exactly the same thing. You need to understand who they are, how they behave, to be able to build this trust relationship. And everyone that we see that is fully in the startup environment has no problem fundraising, just because they talk the same language.
Yeah, and at the end of the day, it makes sense. They're looking to invest in people that they can see themselves working with for 2, 3, 5, sometimes even more years. And that kind of means someone that you can relate with in
Yeah.
some way or another. And I guess that's probably one of the biggest reasons that the market isn't as efficient as a lot of people would hope or say it is already. And by efficient, I mean the best companies, getting access to the best deals from the best funds. And there's still quite a lot of work for that
Yeah.
to be the case.
And I think one of the biggest mistakes that entrepreneurs make when they go fundraising is to try to be very scholar. So they try to answer every question that investors have, and they kind of behave as investors like they are the teachers, when in reality they should talk to investors like like they talk to friends. They should be really convincing. They shouldn't say everything. It's a mix between dating and actually meeting a friend that you want to convince to join as a founder, as an employee, which makes the relationship actually much more normal. You build trust, and like often like same when sometimes we interview young people and they come with suits because they don't really understand the codes of our industry. I think when entrepreneurs go to see investors, they also behave weirdly, as if they had suits. They talk in with weird words. They try to answer too many questions at the same time. When they like very formal in the emails. When my advice to most founders is just like get comfortable with people, meet them over coffee. Of course, it's not possible with Zoom, but like still ask questions, get comfortable, move to WhatsApp if you want to. Much easier to have like a sustained conversation with an investor over a period of 20 days with messages exchanged every day rather than a formal email every 5 days. And I think like so there's a problem of understanding of these people, and I think that's one of the great things that we bring at the family is like connecting entrepreneurs with other entrepreneurs that have already talked to investors, and I think it's a common thing we discuss, like how to deliver advice to people. I think when I started 6 or 7 years ago, if I told someone to behave in a certain way, they probably wouldn't listen to me. I think today it's basically the same. But if I tell them to talk to 5 different founders that tell them the same thing, then it's understood and becomes part of the general culture. And I think models like ours, where we train batches of startups together, are very beneficial to entrepreneurs in that way. They learn just much faster, and it's like learning a language. Like if you don't go abroad, you don't really speak it. It's like an immersion that you have to do. And I think the demo day and the batch model are really interesting in that respect, because founders get to talk to many different investors, whether they fundraise right away or they fundraise later. I think most of the founders that join something like YC are already like very literate in startups. Like they could raise in their own geographies super easily. They might not be able to raise with US investors from there. They will if they go to the US, especially if the US is their market. In our case, most of the founders we talk to are not literate in startups. We have some that are extremely literate and that we help a lot, but most of them are not yet. And we help them get to that stage. And I think it's the most interesting ones. Like if you look at Mark Zuckerberg talking at the D8 conference, where he basically goes into sweat because he's stressed and he's never talked to press or at a conference. I think that's the type of training that we give to people.
I think so. Probably a good time to transition to one of the issues we said we discuss, which is how we fit into this new landscape. So before, I think the pitch was fairly straightforward and was a bit more local in the sense that we, tried to be the best partner for European companies or European founders rather that were looking to build iconic businesses. And we're still very happy to work with European startups, and in the batch actually, a majority of the startups are European. But it was really sort of like this, helping founders and then helping them get access to the best that Europe had to offer. And then we would work with different people in the European ecosystem to make that happen. And now that there's been sort of this big reshuffling, both in terms of deals being cross-border and the types of funds changing, I think it's, it has also shifted our positioning relative to all of these players. So I think the value proposition to founders hasn't changed too much. If anything, it's just become a bit more precise. But how we fit relative to other players has changed a bit. And I was wondering if you had some thoughts on that.
Yeah. So I think it's still early days in the changes that COVID brought to entrepreneurship. I think the rise of remote worked really well. A lot of companies are hiring remotely now, are closing deals remotely. And I think the velocity of ecosystems is going to increase tremendously, especially in ecosystems that were typically slow like Europe. And I think that the funding and acceleration model is also going to change quite a bit. And there has never been a better opportunity to build another great accelerator program than there is in 2020, 2021. We see definitely made it on the rise of Silicon Valley as the main hub for education and the main hub for fundraising and also the main hub for talent. And now that money flows globally, knowledge is everywhere. I think that there needs to be other things that are built, and there's an opportunity to have long-term relationship with founders, to build meaningful communities of founders that exchange on different topics and exchange regularly. And I think nobody has really cracked how to do that. The There's a value of like in-person meetings is quite understood. The higher bandwidth, you get more done in 20 minutes than remotely, except that you lose a lot of time commuting. But I think the difficult part is to replicate the very small interactions that you get in normal life. If you bump into people at dinners, you get a little insights on someone saying, "Oh, I just hired this guy from this company. They're actually doing bad. You can poach their employees." Like this piece of knowledge that takes like 10 seconds isn't really transmitted in the online world because you'd have no reason to get that interaction. And
Yeah,
so I think,
it's one of the funny things with like the cost or time it takes to schedule interaction has gone down substantially, but the threshold to justify one has gone up a lot.
yeah,
And it's not very clear where the net is because like we now have an extra hour in the morning, an extra hour in the evening, and we're probably taking more calls than we used to. Um, but it's still fairly unclear whether on net we're gaining in serendipity or losing in serendipity. And it's true that for that kind of advice, it feels like we're definitely losing, at least for now.
yeah. And it's also one of the things I realized, like switching to remote and asynchronous communication internally. It's those little details that get really lost in the way. The like if you walk behind someone's computer and you see a presentation he's doing and you say, "Oh, this is not exactly correct. You should change just this word," and you go back to the coffee machine, it feels normal. If you do the same in written form, you just look like an asshole. So like communication really needs to change, and I think as we were talking with the North Flank founders, a company of ours that is fully remote from day one, like 8 years ago actually, they say it's a constant communication struggle. You need to over communicate. You need to go into details that seems meaningless to everyone, but are actually maybe going to trigger that little interaction that you would have in the personal world. But to come back to your question, um, so the family has been helping entrepreneurs for 7 years now. Mission stayed the same, which is to be a minority shareholder in companies built by ambitious founders. And by ambitious founders, we mean like people that are never going to stick to where they are. They're always going to push to get the product to more people, make the next feature better than the previous one was. So that has stayed the same. But with COVID, and the rise of remote, we're now able to cater for entrepreneurs wherever they are in the world, and we're able also to present them to investors wherever they are. And so with this batch model, which is not dissimilar to YC, except that it is fully remote, and it tends to stay fully remote because we believe that we're going to be able to crack this community building part online. We have three objectives for founders. The first one is to build meaningful relationships with us, the family. And on the back of those relationships that we hope you're going to keep for the next 10 years, we help you make decisions and we help you gain leverage, whether it's to raise your Series A, whether it's to go international, to hire senior people. I think a lot of the value is because Matthias, Usama, I, Alice, Nicholas have been doing this job for 7 years now, and we plan to do it for the next 10 at least, which means that the relationship you build now is going to help you grow as a founder for a very long time. The second thing that we try to do with this batch model is to help you build meaningful connections with other entrepreneurs. So this last batch was 30 startups. The next one is probably going to be quite a bit bigger, mostly
70.
because we... What?
Let's hope for 70.
Yeah, it's 50, 60, 70, I don't know. I think like with this batch model, there are two great things. The first one is it's easier for us to build relationships with startups at scale. And by scale, we mean like 50, 100, because we have everyone in the same process. And it's on the back of that relationship that we're going to have long-term impact for founders. The second one is that they build the relationships together. And if I have more startups and a bigger community, I have more likelihood of people building those meaningful connections between each other, especially when you do that remotely. It's much easier to build a relationship with 10 people when you go have dinner with them. But if you are if you're fully online, I think a larger number helps finding the person that really shares something special with you. And so those tiny interactions with other founders are like producing a positive emulation between founders. And I think it's been the main driver of the execution level going up. The same way 6 or 7 years ago when we started, we used to send companies to the Silicon Valley because the tons of interactions they would get there would just improve the way they do product, improve the way they think about their strategy. I think the batch model and connecting founders with many other founders does exactly the same. And typically, second-time founders already have pre-existing networks who they contact, who they talk with often. First-time founders need to build those networks, and especially founders in geographies that are not the main hubs. Like if you're a founder in a small city in Bulgaria, you probably have very few people to talk to that understand what you're doing, building like infrastructure for fintech. And a company like The Family can help you get connected to a lot of other founders doing not exactly the same business, but similar businesses that help you think about your own. And I also think it's something that CEOs do pretty well, but CTOs, CPOs, CMOs, and all the other Cs do very little. And at The Family, we encourage every founder to build his own network of peers that he talks to often. And the bigger network, the better. The worst thing you can do is to talk to only 2 companies that are also building marketplaces or also building SaaS, because the likelihood that you do the same thing in the end is very high when actually your businesses are probably very dissimilar. And we've seen it a couple times at The Family where marketplaces that sell to SMBs or sell to large corporates or sell high margin product or low margin product make the same decisions, which is a recipe for disaster.
Yeah, and I think one of the other cool things about this batch model that we've seen this time that we didn't necessarily have when we were on the more continuous model is that being a sort of program that's finite in time and that has the sort of shared deadline of demo day creates a collective sense of pressure that we didn't necessarily have before, because obviously the opportunity cost of not being ready by demo day is just much higher. I think it was one of the best hacks of YC when they started with their model. Wasn't so much having the demo day with investors present. Like even if demo day was a hoax and actually nobody showed up, I think pressure that you get from working intensely for 2 months, 3 months thinking about nothing else, just sets a great vibe and ethos in the business
Yeah,
that's more than compensate anything that you actually end up raising at demo day or any relationship that you end up building. And
yeah,
I think
definitely.
that's the thing I'm happiest with is like sometimes you get out of the ordinary founders who are able to put that pressure on themselves, but on average it's quite difficult to keep that level of intensity up. And having somebody every week who's like, how many deals did you sign this week, um, is the uptime higher than it was last week, blah blah. And even though you ask themselves those even though you ask yourself that question as a founder, it still tastes a bit different when it's somebody else that's putting the pressure on you. um, and I think that's probably the best thing, almost above community and above
Yeah.
anything else, above our lives being easier, with the
Yeah,
fact that all
and the
investors
great
come.
thing is that there were 500 investors at demo day, so it was
Yeah.
zero pressure. But yeah, I think about it the same way. One of the funny thing I've discussed with founders is every time I talk to them, they feel like they can't work more or they can't work more efficiently. And every time I'm telling them that they will at one point work more or work more efficiently, and they realize months later or years later, and they write to me and they're like, "I've never worked more than I do now," and so I think the being in that super high pressure environment before demo day helps you realize earlier that you could do more or more efficiently than you were doing before. A bit like when you see when the first guy did the 100 meters below 10 seconds, everyone started to do it. Here is the same. It's just like this moment of reckoning, and because when you need to build your business, have growth, listen to all the content that we teach you, which is like basically helping you understand the investor landscape, understand what your strategy is, and then you need to build all the materials to be ready for fundraising. That's actually a lot of things to do in 24 hours. So you become you just work probably if not 2 times, 1.5 times more than you used to. And I think that pace that you get early on in the business is something that you keep for a very long time, and it helps you reduce every cycle, whether it's product hiring or just like making decisions. And indeed, I was really pleased at the effect it had on founders, and I think nobody felt it as like made up pressure. It really felt genuine for everyone.
Well, yeah, but it is genuine. It definitely is
Yeah,
genuine. Because it's quite rare that you get the opportunity to have that many people listen to what you're building at the same time. So it's pretty justified. Maybe before we move on to the next questions, we can just take some of the questions that were asked in the chat.
yes.
Um,
And thanks, Sheish, for all the questions. I think a lot of your questions are relevant.
so do you want to start
Mathias,
just
maybe you can start with now that the crypto scene is taking shape in the mainstream bit by bit, what do you think is the next positive black swan that could help creators empower themselves? Whoa.
that's not the easiest question to answer unprepared. I mean, I'm guessing
I think
that.
you can talk about trust.
What do you mean trust? What, just the fact that it's not
Like
a scam anymore?
discovery is easy, payment is easy, but
Ah, trust. Yeah.
how do you build the trust for the interaction to happen in conditions that are either decentralized or that are I don't know whether it's reviews or what Pasabi is doing.
Yeah, definitely. I was gonna mention Pasabi. Balthazar is pointing to a company in our portfolio called Pasabi, that is what they call building the trust layer of the internet. And so what that means in practice is that they're helping fight people who are selling fake goods. So, like on Instagram accounts or eBay accounts who are selling fake bags, or people who are posting fake reviews. And so they help brands and marketplaces get rid of those fake accounts essentially. or fake reviews in order to increase the level of trust and hence increase the number of transactions, because ultimately, you need the website to function, and then you need payments to go through. But before all of that, you need people to trust the platforms that they're using and the sellers that they're interacting with. And it's true that I think crypto had this issue for a while, in the sense that decentralization is great in trust building and that you can trust the math or whatever. But at the same time, there probably haven't been as many scams in any other sector of tech as there have been in crypto for the past 10 years. And so for mainstream adoption, I think we're still missing some degree of trust. And the funny thing is that if you look at it, all of the trust, like all of the mainstream trust, has so far come from centralized applications, right? So like people, the mainstream and sort of layperson buy Bitcoin with Coinbase, and Coinbase is in effect a centralized ledger. And I think if you want to have more and more of these applications, you need to have these trusted mainstream brands, because at the end of the day, people are very happy to trust the math, but they still want, at least on the interface level, a trusted brand that they can relate to. And for now, we have those on, I think basic transactions, basic transactions and sort of like buying and holding crypto. But even if you look at the latest craze around NFTs, they're still pretty verticalized. And so you have, Dapper Labs that are doing it for NBA. You have SoRare that's doing it for football. But you don't have like a top of mind brand where people are comfortable going and buying digital assets, for example. And I think that's probably the next big thing as far as crypto goes, is what brand is going to build trust for things other than the currencies. Is probably
I think beyond crypto, there is we're gonna I think we're going to reinvent a way to build trust with consumers in the way we build companies, or in the way we deliver media, or in the way we sell products. And I think over the last decades, consumers have lost trust in most of the things they trusted. Whether it's like the U.S. government with the Vietnam War, the church with all the scandals, or like the banks in '08, or like the car industry with Volkswagen lying on carbon. I think trust has disappeared, and that's, I think, is the main reason that individuals are getting becoming so important today. Whether it's influencers or just like the face of people rather than the brand that they carry, and we even see it at the family. When Usama speaks, he gets more likes than when the family speaks. I think people have completely lost the trust in the corporate communication, and they're looking for like this authenticity, this transparency. And I think we're going to build new ways of building companies. And I think that's the main thing that is lacking for creators also to empower themselves. Is how do you know that a person is saying is not being paid to do something, or is like actually authentic? I was thinking about it recently, and it strikes me that like most secure, most trusted cryptographic is open source. Most trusted news is probably the community rather than the New York Times now. I think we'll figure out a way to do that. Maybe we can take another question.
Yeah. So we can take. So there's a quick question to answer on whether or not invoicing ERP is a sector in which VCs are willing to invest very much. I think Balthazar almost explicitly mentioned that as it's a good intersection of fintech and SaaS, where I think every VC will be very happy to have a look, depending on what you're building.
They
Um,
will all take a look and they will all say that it's a crowded space, and they don't know yet how you're going to differentiate in the future. And you can say that you're going to have network effect and whatever. That's something that's going to kick in when you get a lot of clients and not in the early days. So if you're building that type of project, I think either you're a superstar founder and then you can raise super easily, or you need to prove a lot of traction. And by a lot of traction, I mean really a lot, because nobody knows if it's really a winner take all market or not.
Another question we have is the question, yeah, about the European ecosystem, which is the one I think you were about to answer. If you want to take it.
So do you think some things are missing in European tech or even global tech to create better ecosystems? So yeah, definitely. I think one of the main thing is that the ecosystem velocity is pretty low. I think everyone should start taking meetings that are like shorter, make more intros, and behave like they trusted the person that sends them something rather than the opposite. I think Europe is just very slow and very risk averse. We hire slowly, we fire slowly, we test out new products very slowly. We don't make intro, we don't invest. We definitely should try to all collectively improve the velocity with which we do all these things. Um, then I think we're also lacking, as I said before, I think like an early stage angel scene that invest in diverse businesses would help a lot. I think there is always a chicken and egg problem, whether like funding brings better entrepreneurs or entrepreneurs brings better funding. We're a strong proponent of saying that we get the investors we deserve, and the better the ecosystem is, the better money you get. But still, I think that some ecosystems like the US are able to take risk well before the curve of adoption kicks in for new technology, which helps like a lot of teams create knowledge, helps funds becoming like knowledgeable also about the industry. And if you take crypto, because we just mentioned it, I think like 95% of the investment comes from the US, when actually there is a lot of activity in other geographies like Switzerland for regulatory reason, or Berlin for cultural reason. Um, I think, yeah, more money at the early stage would definitely do some good. And
And they, I mean, it makes sense, right? Because if you look at, I mean, it makes sense from their point of view as well. Because if you look at the U.S. funds, I mean, a good example was the S1 that Coinbase published. Like, if you look at all the funds that have the most substantial holdings and that invested earliest, like USV and Andreessen, now they essentially have very strong brands in that field, and they probably have a first look on all of the deals. So it's not just out of charity and pure risk appetite. It's also a fairly strategic thing to be the first to make investments in those new spaces.
yeah, completely.
And they invested not just they have invested in everything. Like they did the consumer layer with Coinbase. They did some applications with Dapper Labs and CryptoKitties. They did some of the funds with Polychain, etc. Like it's pretty systematic.
Yeah. And yeah, in Europe, I think we also need more people starting businesses. I think it's become trendy to be a founder, yet not so many people do it because they have some risk aversion, because Europe doesn't really tolerate failure, at least not the same way the US does. And to be fair, in the US, they don't like losers, but they love comebacks. So you can fail once. If you try again and you succeed, everyone will be super happy. The problem with Europe is that if you fail once, you're considered a loser for life, which is true in which happens to be true in like traditional environments. And I think one of the really liberating thing of the startup ecosystem is that acceptance of taking more risk and being only doing like asymmetric bets where you don't lose a lot, but if you win a lot, which I think is it's contagious. Once you get there, you don't want to come back. Where in a environment where you can't fail. I think there's a question from Cyril that we can take also.
Yeah. So it'd be the three reasons that investors are looking at when making a decision. Are there any requirements in terms of revenue, etc.? So for the earliest stage round, I wouldn't say that there's a requirement in terms of revenue. I think this is a very common misconception, and a question as a consequence, I don't like answering that. People ask you for a benchmark, and then you give some benchmark saying usually people raise with this much revenue, and then founders go to speak to investors. They say that they have that much revenue and that they struggle to get a term sheet, and they wonder why, because they have the right revenue number. The real thing is that there isn't really a benchmark for a simple reason. Revenue is just one of the many things that investors are looking at. So obviously, the more revenue you have, the better. And the less time and effort and resources it took you to get that revenue, the better. But there isn't a sort of minimum threshold that you need to have. And then in terms of the three things that they'll be looking at, I guess what three things they'll be looking at will really depend on the quality of the investor that you have in front of you. In general, they'll be looking at you, what you've done, what it seems like you're going to be able to do and learn. And if your team has different backgrounds and sort of skill sets or qualities or aptitudes that seem relevant to the problem that you're tackling. And then the second thing they'll look at mostly is the market you're taking on. So is the market big enough to accommodate a large company? Is it fragmented enough that you can pick up quite a lot of the value that there is in that market? And I'd say those are the two things that they look at the most. And then maybe as a third, but lesser point, they'll probably look at how crowded that market is. Balthazar pointed it out when he was talking about the invoicing software. I don't think that they'll necessarily use that for the right reasons, but it's just that VCs or investors more generally, but tech investors in particular, tend to live in a pretty intense echo chamber where large fundraising rounds give a lot more importance to individual companies than those companies have in the real world, and in particular in the market in which they're operating. And so we have loads of examples of companies that raise a large round with a famous fund, and then all the other investors are scared of funding another business in that space, despite the fact that the market is huge and that there's a lot of room for several companies to make hundreds of millions in revenue. But that is probably something that will come up at one point. Is it a crowded market, and have a lot of venture-backed companies been announced in that space?
Yeah, definitely. They're going to look at team, market, and execution. And it's three different type of risk. They don't like to take on the three of them. So in very in known market, they will tend to invest in teams that have a track record. In a very new market, they're usually started by teams that found that market by luck. So then they're going to look at traction mostly. And that these are the three things. And often, I think one of the good advice that I would give is not to try to raise too much money too early on. Like the bar to raising $1 million is quite high. The bar to raising 3 million is of course higher. And there's a lot of you can do with less money. And if you were to raise $1 million, you wouldn't spend 100K per month straight out of the gate. You would hire one person, then another. So I think for a lot of the pre-seed founders, especially if you're not second-time founders or like super experienced, you should raise a couple 100K, start growing, have traction, and um, then go to the next round. In Europe, it's not really done. It starts to appear. I think you can definitely have like, I don't know, 200K, 300K for less than 10% dilution, which brings you to a level where you have answers for team, market, and traction, and you can then fundraise with VCs globally.
And maybe one last question before we get back to the things that we were kind of discussing about uh, most common reasons for arguments or distrust between founders. Um, I think honestly, I think the most common reason for arguments is just that business starts going badly, and then once you start, getting a bit desperate and the business isn't doing very well, um, unfortunately, people don't have their best sides that come out, and so you start having a bit of a blame game, and people start to focus more on their internal problems than on outside problems. On the opposite side, when things are growing super fast and you have more clients than you know what to do with, and the product is breaking because too many people are using it and they're using it in ways you didn't expect, all of a sudden any disagreement that you have kind of disappears and you're focused on trying to make the most of the growth and outliving the growth. So I think that's probably the most current, the most common trigger for the disputes or the mistrust or the arguments is just things going badly from a business standpoint. Um, and then I guess that I'd say that's probably the most
Yeah.
common.
And it's really hard to trust your co-founder fully. I mean, like you need to trust that he's going to be better than you are when he talks to investors, trying to convince them. You need to believe that the other one is going to be better at not fucking up a big contract when he goes to the meeting. And so, like that trust needs to be built over time, and it's really paramount that you keep it along the way. And every decision is difficult. Sometimes you need to acknowledge that the other might be right and you might be wrong, and that you're not going to blame the other person for making the decisions afterwards. Otherwise, it's just like you just build up on frustration.
Cool. Should we go back to the things that we want to talk about, and then maybe take one or two questions at the very end if we have any left?
Yes,
But,
definitely.
so I think one of the things that we didn't talk about was we talked a bit about how the family fit and how the market changed for us. But I do think it would be cool if we could talk a bit about the advantages of why the batch format now makes sense outside of Valley and why it didn't before. We touched upon it a bit, but we didn't really talk about it specifically. Why didn't we do a batch format when we started 7 years ago?
So there are many reasons why we didn't do it. One of them is that there were too few investors that we wanted to show entrepreneurs to. So a demo day wouldn't make sense. But to be fair, the level of the entrepreneurs we were able to work with was also quite different from today. The knowledge they had about what it meant to build a startup was pretty low. They were definitely not fluent in fundraising terms. And so we focused on bringing entrepreneurs from 0 to 1, and that 0 to 1 could take a couple months for some. It would take a couple years for most of the entrepreneurs. And so we really enjoyed doing our job like this. It was really craftsmanship, and it's in long-term relationships that we built with the founders that we learned everything that we know today, and that we've known how to help founders make decisions over time. Actually, COVID and the rise of remote has been a lucky event for us. So fortunately, everyone is safe and healthy. But on the business perspective, it opened up the gate for a lot of founders from remote geographies. We just worked with founders from Israel, the Philippines, China, Egypt, and it opened up the gates for investors. There are tons of US investors looking at our deals. There are like random angels from different geographies that want to take on rounds on their own, which is really good news. But the thing that we touched upon that I like most is that founders really live a strong experience in a defined time moment where they meet a lot of other people that are living the same thing that they do, which is important because entrepreneurship can be very lonely. Plus, they get exposed to some of the best in class execution and some of the best in class advisors, which is like habits that are gonna stay for hopefully a long time.
Awesome. Let's do one of the last questions that we didn't address because I thought it was a fun question about whether we know some founders who take inspiration of the past instead of the future to build a startup.
Yeah, I don't know anyone taking inspiration from the future. I think entrepreneurship is not about predicting what's going to happen in the future. It's about building it, and a lot of the strategies and tactics are inspired by the past, whether it's other business success stories or whether it's I don't know like war tactics. I think a lot of the things that we do are driven by human psychology, and this hasn't changed for 2,000 years. So if you read l'Iliade, you're learning a lot about how people behave, and I think like the past is definitely the inspiration for how people make decisions. Then it's a future they envision that helps them wake up in the morning and of course, they need to take a bet that the world is going to go one direction or the other. But hopefully, they make tiny bets every day, which lead further than a big. At least it's probably less risky than just a big bet.
Awesome.
But don't get me wrong, we love a founder with a good vision.
Yeah, and I think they all have kind of some vision of what the future could be. But it's true that it's rare that they come. Like we don't really have many who come and say, I read a McKinsey report about the state of the future of logistics in 2030, and so I think I need to build this business.
Yeah,
But
I think we need to acknowledge that nobody is able to predict the future. Like nobody saw COVID, nobody saw Trump, nobody saw like it's getting weirder every day, and I think we just need to cope with reality. There are a few things that are true. More people are going online. More people want to become independent. More people are getting access to knowledge, and based on those trends, a lot of things are going to be possible. But that's about it.
Yeah, I think the world getting weirder. The world getting weirder is something that we still struggle to grasp collectively, and all the implications that come with it. Like every time, it feels like people are surprised by how weird it gets. In the same way that the founders you talked about never thought they could work any harder, it feels like people always overlearn and think the world can get any weirder.
Yeah,
I can take the last question. I'll take the last question before we leave. After 3 months, I finally found a co-founder, but he wants 40%, even though I finished my MVP and found our users after ads on Facebook. Is it normal to give 40% after the MVP and 300 users? So I don't think there's a sort of general rule for what equity looks like. But the one thing I would say is that 400, an MVP and 300 users on the scale of what you're probably trying to achieve is probably not much at all. And the equity that you give to your co-founder shouldn't reflect what you've done so far, and as much as what you expect both of you to do going forward. And I think that 40% doesn't seem completely unreasonable if you think that he's the right person to be building this business with. You want somebody who works just as hard as you and who's as committed as you are to this business. And I think it makes sense that you're pretty close to equal. I'm guessing that the
Yeah,
split you're implying is 40-60.
I think you could even give 50 if the person's
Yeah,
really good and wants to commit for the next 10 years.
exactly.
Cool.
Awesome.
Thanks,
Thanks
Matthias,
everyone for
for the.
joining. Thanks, Belt, for the back and forth. And looking forward to having you next week. I don't remember who it is next week. I think it might be Usama and I, but not sure. Have a great day, everyone, and
Cheers, everyone.
take care. Bye bye, Belt.
Bye.